There is a silent transaction that happens in the stock market every single day. An exchange of capital so subtle, yet so profoundly powerful that it separates the architects of generational wealth from the temporary participants. It's a move that creates value from what appears to be thin air, a financial maneuver that, when executed with intelligence and precision, is perhaps the most potent and misunderstood weapon in the arsenal of corporate finance. Warren Buffett has called it the single best use of corporate cash when the conditions are right, yet the average investor, and even many so-called professional money managers, consistently misunderstand its purpose, misinterpret its signal, and are instead seduced by far louder, far more destructive corporate actions. We are talking about the principle of intelligent share buybacks. For the long-term owner of a business, which is what an investor truly is, there is almost nothing more beautiful than watching the company you own use its own money to buy out your less committed partners at a discount, thereby increasing your personal stake in the enterprise, for free and with remarkable tax efficiency. This isn't a trick, it's not a gimmick, it is the mathematical certainty of ownership. By the end of our journey today, you will possess a new lens through which to view every company you analyze. You will learn to distinguish between management teams that are actively, intelligently, and quietly working to make you richer, and those who are simply playing a game of corporate theater, often at your expense. You will understand the costly market mistake that seduces 99% of investors, and you will be armed with the financial transformation that comes from seeing what they cannot. This is the secret engine of portfolio growth, the quiet compounding machine. This is the story of how the smartest companies in the world can make you rich, not by what they build or what they sell, but by what they buy, themselves. Our exploration into this powerful concept begins not in a modern trading room with flashing screens, but in the staid, ink-stained world of 1970s print journalism. This is where a young Warren Buffett, already a seasoned investor, but not yet the global icon he would become, made one of the most formative investments of his career. It wasn't just the purchase itself that was brilliant, it was what happened in the decades that followed, a masterclass in capital allocation that would amplify his initial returns into the stratosphere. This is the story of the Washington Post Company. To understand the genius at play, we must first immerse ourselves in the context of the time. In 1973, the stock market was a place of deep pessimism. The Nifty 50 bubble had burst, the country was mired in the Watergate scandal, a story the Washington Post itself was breaking, and the valuation of even great American businesses had been crushed. The Washington Post Company, a premier media institution run by the formidable Katharine K. Graham, was no exception. Despite its powerful brand, its near-monopolistic position in its market, and its growing profitability, its stock was trading for a pittance. The entire company, a gem of American enterprise, had a market capitalization of just around $80 million. Buffett, a voracious reader of newspapers and a keen student of businesses with durable competitive advantages, or moats, saw this for what it was, a spectacular absurdity. He estimated that the intrinsic value of the business, what a rational private buyer would pay for the whole company, was at least $400 million, and likely more. The market was offering him dollar bills for 20 cents, so he began to buy. Over the course of 1973, Berkshire Hathaway systematically acquired shares of the Washington Post, investing a total of $10.6 million. This purchase gave him a significant but still minority stake in the company. Many investors would have stopped there, waiting for the market to correct its mistake and for the price to rise to its true value. But for Buffett, the investment had only just begun. The real magic, the force that would turn this great investment into a legendary one, was set in motion by K. Graham. Graham was not just a brilliant publisher, she was a student of business and a trusted friend of Buffett's. She understood, with his guidance, that the single most productive thing she could do with the company's growing torrent of excess cash was not to chase flashy acquisitions or pay out hefty dividends. It was to repurchase her own company's shares while they were trading at a ridiculous discount to their underlying value. And so began one of the most relentless and intelligent share buyback programs in corporate history. From 1975 onwards, the Washington Post Company began to systematically use its profits to buy its own stock on the open market. Each share they repurchased was a share they didn't have to pay future dividends on. More importantly, each share they repurchased was permanently retired, effectively vaporized. Think of the company as a pie. By buying back shares, Graham was reducing the number of slices the pie was cut into. The pie itself, the collection of assets and earning power of the Washington Post, was still growing, but now the remaining owners, including Warren Buffett, owned a progressively larger slice of that ever-expanding pie. The numbers are staggering. Over the subsequent decades, the Washington Post Company repurchased over 40% of its shares outstanding. Let that sink in. Nearly half of the ownership claims on the business were extinguished. Buffett, who had initially purchased around 9% of the company for his $10.6 million, saw his ownership stake swell dramatically, approaching 15% and beyond, without Berkshire Hathaway having to invest another dime. His percentage of the profits, his claim on the assets, was being increased for him automatically, year after year. The effect on his investment was explosive. That initial $10.6 million investment, by the time Berkshire fully exited the position decades later after the company was sold to Jeff Bezos, had blossomed into a holding worth over $1.2 billion. That's a return of more than 100 times his initial investment. A significant portion of that monumental gain was not due to the operational growth of the business alone, as impressive as it was. It was due to the simple, elegant, and relentless arithmetic of the share buyback. Graham and Warren Buffett understood a fundamental truth. Buying your own dollar for 20 cents is a transaction you should make all day long. This foundational anecdote reveals the core mechanism of value creation. It's not about financial engineering in a negative sense. It's about rational capital allocation. It's a direct transfer of wealth from sellers, those who are impatient or don't understand the company's true worth, to the continuing, long-term owners. It's the company, in effect, investing in its most knowledgeable area of expertise, itself. The reason this quiet, powerful strategy is so often overlooked in favor of more dramatic corporate maneuvers lies deep within the wiring of the human brain. The preference for flashy acquisitions over patient share buybacks is a textbook example of a powerful cognitive bias known as the bias for action, or what the brilliant investor Charlie Munger calls the something-doing impulse. Our brains evolved in an environment where immediate action was often critical for survival. When faced with a threat or an opportunity, the instinct is to do something, anything, rather than to sit still. In the corporate world, this translates into immense pressure on CEOs and management teams to be seen as proactive, dynamic, and visionary. A multi-billion-dollar acquisition is a dramatic, headline-grabbing event. It generates press releases, television interviews, and a sense of forward momentum. The CEO is seen as a bold strategist, an empire builder. It feels like progress. A share buyback program, on the other hand, is silent. It's an internal, almost administrative, function. There are no grand announcements of synergy, no new divisions to manage, no celebratory dinners. It feels passive, like an admission that the company has run out of good ideas. This psychological pull towards action is incredibly difficult to resist. The board of directors, the shareholders, and the financial press are all implicitly asking, "What are you doing to grow?" Buying another company seems like a direct answer to that question. Buying back your own stock seems like an indirect, almost esoteric one. This is compounded by the fact that acquisitions feed the ego. They increase the size of the company, the number of employees, the revenue figures, all metrics that are often tied to a CEO's compensation and prestige. A share buyback actually shrinks the company's cash balance and does nothing to expand the CEO's direct managerial domain. It is an act of capital discipline that requires overriding the innate psychological and institutional desire for more, for bigger, for action. Buffett and Graham were able to resist this impulse because they operated from a different mental framework. They saw themselves not as managers of a public corporation, but as owners of a business. An owner's primary goal is not to grow the empire at all costs, but to increase the per-share value of their holding. If you could buy out your partner in a private business for a fraction of what their stake was truly worth, you would do it in a heartbeat. That is precisely what an intelligent share buyback is, conducted on the grand scale of the public markets. By understanding this underlying psychological principle, you as an investor can begin to see why so many companies make poor capital allocation decisions. You can recognize the siren song of the big acquisition and appreciate the quiet wisdom of a management team that has the discipline to resist it, opting instead for the mathematically superior but psychologically less satisfying path of the intelligent repurchase. So how can you, as an individual investor engaged in your own wealth management, translate this powerful concept into a practical tool for stock analysis? The key is to adopt a simple but effective mental model, the shrinking the pie slices model. This is your blueprint for identifying and quantifying the value being created by a buyback program. It's a step-by-step process. Step 1 is to establish your baseline. When you analyze any company, one of the first things you should look for in its financial statements, specifically the annual report or the 10K, is a line item called shares outstanding. This number represents the total number of slices the company pie is currently cut into. You need to find both the basic and the diluted shares outstanding. Diluted is often the more conservative and useful number, as it includes potential shares from stock options and other convertible securities. Make a note of this number and the date. Step 2 is to track the change over time. This is where the real work of stock picking and value investing comes in. You cannot judge a buyback program on a single quarter's announcement. You need to see a pattern of intelligent behavior. Go back 5 or even 10 years. Look at the company's annual reports for each of those years and plot the number of diluted shares outstanding. Is the number consistently going down? A company that is genuinely committed to increasing shareholder value through buybacks will show a clear downward trend in its share count over a multi-year period. A flat or, worse, an increasing share count tells you that despite any announcements, the company is either not serious about buybacks or is issuing so much stock for acquisitions or executive compensation that it's negating any repurchase efforts. Step 3 is to connect the shrinking share count to per-share metrics. This is the crucial link. A lower share count, all else being equal, automatically increases the earnings per share, or EPS. If a company earns $100 million and has 100 million shares, its EPS is $1. If it buys back half its shares and still earns that same $100 million, its EPS is now $2. The business hasn't become more profitable, but your claim on those profits has doubled. When you analyze a company, don't just look at the growth in net income. Look at the growth in earnings per share. A company whose EPS is growing significantly faster than its net income is giving you a massive clue. It's a signal that a powerful buyback program is at work, acting as a potent accelerant to your returns. You can apply this same logic to other per-share metrics, like book value per share or free cash flow per share. The principle is identical. You are looking for management that is focused not just on growing the overall pie, but on relentlessly growing the size of your individual slice. This mental model transforms you from a passive observer into an active analyst, allowing you to see the hidden tailwind that intelligent corporate finance can provide for your long-term portfolio growth. To truly appreciate the wisdom of this path, we must dedicate some time to exploring its opposite, the path of the 99%, the path of the value-destroying, empire-building CEO. This is the antithesis of intelligent capital allocation. This is the world of flashy, expensive acquisitions that thrill the media but impoverish the shareholders. The poster child for this kind of corporate malpractice is the infamous merger of AOL and Time Warner in the year 2000. It stands as a monumental cautionary tale. At the peak of the dot-com bubble, AOL, the high-flying internet company with an astronomical stock valuation but relatively meager profits, decided it needed to acquire a traditional media giant to secure its future. Time Warner, a behemoth with iconic brands like CNN, HBO, and Warner Brothers, was the target. The resulting deal was hailed at the time as a visionary fusion of new media and old media. The cover of Fortune magazine celebrated the architects of the deal. It was the ultimate something-doing move. But beneath the surface, it was a catastrophe in the making. AOL used its own wildly overvalued stock to purchase Time Warner. The combined entity, AOL Time Warner, was an unmitigated disaster. The corporate cultures clashed, the promised synergies never materialized, and the dot-com bubble burst, cratering the value of the old AOL business. The result was one of the largest destructions of shareholder value in corporate history. In 2002, the company reported a loss of nearly $100 billion, the largest annual loss ever recorded at the time. The stock price collapsed, wiping out hundreds of billions in market value and devastating the portfolios of countless investors who had bought into the hype. What is the lesson here? The management of AOL, flush with a high-priced stock and the psychological need to make a big move, chose the path of empire building over the path of rational value creation. What could they have done instead? Had their stock been undervalued, they could have repurchased it. But it wasn't. Given their overvalued stock, the rational move would have been to do nothing, or to use their currency to make a much smaller, more sensible acquisition. But the lure of the massive, transformative deal was too strong. This is the path most companies take when they are flush with cash or a high stock price. They suffer from what Buffett calls the institutional imperative, the tendency of organizations to mindlessly imitate their peers, regardless of whether the behavior makes sense. Everyone else is doing big deals, so we should too. This leads to bidding wars for hot assets, paying massive premiums over intrinsic value, and taking on huge amounts of debt, all in the name of growth. The average investor is easily impressed by this. They see the headlines, they hear the talk of synergy and transformation, and they buy the stock, believing that bigger is always better. The intelligent investor, armed with the knowledge of the Washington Post and the folly of AOL Time Warner, knows better. They know to be deeply skeptical of grand acquisitions and to search instead for the quiet, disciplined company that is focused on making the pie slices bigger, not just baking a bigger, less profitable pie. The ultimate test of any financial principle is its direct connection to the numbers, its tangible impact on a balance sheet or an investment portfolio. The power of intelligent share buybacks is not a theoretical or abstract concept, it is a brutal mathematical reality. Let's quantify the financial advantage. Imagine two identical companies, Company A and Company B. Both are excellent businesses that generate $100 million in excess cash each year. The intrinsic value of each business is $1 billion, and each has 100 million shares outstanding, meaning each share is intrinsically worth $10. Now let's introduce a market downturn. Fear grips investors, and the stocks of both companies fall to $5 per share, a 50% discount to their true worth. This is where their paths diverge, dictated by their approach to capital allocation. The management of Company A are empire builders. They see the downturn as a chance to buy a rival company. They use their $100 million in cash, plus some debt, to make a flashy acquisition. The deal is complex, the integration is difficult, and while revenue might go up, the actual profitability and return on capital for the long-term owner are diluted. They have expanded the empire, but they haven't necessarily made their existing owners richer on a per-share basis. The management of Company B, however, are intelligent capital allocators. They see their stock trading at $5 and know it's worth $10. They recognize this for what it is, the single best investment opportunity available to them. They take their $100 million of excess cash and use it to buy back their own stock on the open market. At $5 per share, they can repurchase 20 million shares. These shares are then retired. The company now has only 80 million shares outstanding. What has happened to the intrinsic value per share? The company spent $100 million in cash, so its intrinsic value is now $900 million. But that 900 million is now divided by only 80 million shares. The new intrinsic value per share is $11.25. In a single year, by doing nothing more than repurchasing its own stock at a discount, the management of Company B has increased the underlying value of every single remaining share by 12.5%. The shareholders didn't have to do anything. They paid no taxes. Their ownership of the business simply became more valuable because the company bought out some of their partners on the cheap. Now compound this effect over a decade. If Company B can continue to find opportunities to repurchase its shares at a discount, the share count will continue to plummet, and the intrinsic value per share will continue to rocket upwards, even if the overall value of the business grows only modestly. This is the direct financial connection. It's an arbitrage on your own value, executed by a savvy management team on your behalf. It is a powerful force for portfolio growth that operates independently of market sentiment or economic forecasts. It is pure financial logic, a strategy that turns market pessimism into a direct and massive financial advantage for the patient, long-term shareholder. The critical distinction, the element that separates a work of financial genius from an act of corporate suicide, is the price paid. A share buyback is not inherently good or bad. Its quality is determined entirely by the relationship between the purchase price and the intrinsic value of the business. Repurchasing shares at a significant discount to their underlying worth is a magnificent way to build shareholder value. Repurchasing shares at a price far above their underlying worth is a surefire way to destroy it. This is the litmus test, the single most important factor in evaluating any stock buyback program. There is no better illustration of this principle than Warren Buffett's own evolving stance on the buyback policy of one of his largest and most successful investments, the Coca-Cola Company. In the late 1990s, the stock market was in the grips of a speculative frenzy, reminiscent of the dot-com bubble that would soon burst. Blue-chip stocks, seen as safe havens, were bid up to astronomical valuations. Coca-Cola, one of the greatest brands and businesses in the world, was a prime example. Its stock was trading at a price-to-earnings ratio of nearly 50. The price had become completely detached from the fundamental earning power of the business. At this time, Buffett was a long-time shareholder and a prominent member of Coca-Cola's board of directors. The company was generating enormous amounts of cash, and the management team, as was common practice, was using a portion of that cash to buy back its own shares. But Buffett, the champion of the intelligent buyback, was vocally opposed to this. Why? Because he knew that paying 50 times earnings for any business, even one as wonderful as Coca-Cola, was a terrible investment. He understood that every dollar the company spent buying its own stock at that inflated price was a dollar of shareholder money being vaporized. It was the equivalent of paying $2 for a $1 bill. It was a textbook example of a value-destructive buyback. He argued that the company would be far better off retaining the cash, paying a dividend, or even looking for other investments, because buying their own stock at that price was the worst possible use of their capital. Fast forward 2 decades. The market environment has changed. Buffett's holding company, Berkshire Hathaway, has made a colossal investment in another iconic American company, Apple. Apple, like Coca-Cola, is a cash-generating machine. And like Coca-Cola in the past, Apple has a massive share repurchase program. But this time, Buffett's attitude is completely different. He is an enthusiastic supporter. He frequently praises Apple's CEO, Tim Cook, for the company's relentless and aggressive buybacks. What changed? It's not the mechanism, it's the price. While Apple stock is by no means a bargain basement security, Buffett believes that for most of the period during which the buybacks have occurred, the price has been at or below his calculation of its intrinsic value. He sees Tim Cook using Apple's mountain of cash to repurchase shares at what he considers a reasonable price, thereby increasing Berkshire's ownership stake in what he considers to be the best business in the world. He isn't just a passive beneficiary, he is an active endorser of the strategy. This contrast between Coca-Cola in the late 90s and Apple today is the perfect encapsulation of the principle. The same action, a share buyback, can be either brilliant or idiotic. The deciding factor is price. As an investor, your job is not to simply cheer when a company announces a buyback. Your job is to become a discerning critic, to ask the hard question, at what price? The human mind is a minefield of cognitive biases that often lead to poor financial decisions. When it comes to value-destructive buybacks, two psychological traps are particularly dangerous for corporate executives: the endowment effect and the sunk cost fallacy. Understanding these principles of behavioral finance is key to grasping why so many intelligent, well-intentioned leaders end up destroying shareholder value. The endowment effect describes our tendency to overvalue something simply because we own it. In a classic experiment, participants are given a simple coffee mug and then asked how much they would sell it for. A separate group, not given a mug, is asked how much they would be willing to pay for one. Consistently, the owners of the mug demand a much higher price to sell than the buyers are willing to pay. The mere act of ownership imbues the object with a higher perceived value. Now apply this to a CEO and their company's stock. They are not just an owner. Their identity, reputation, and career are deeply intertwined with the company. It's their mug. This psychological attachment can make it incredibly difficult for them to objectively assess the stock's value. They are predisposed to believe their stock is always a good buy, to see its current price as a fair or even cheap representation of the company's glorious future. This makes them highly susceptible to authorizing buybacks even when the stock is objectively wildly overvalued. They are buying based on an emotional attachment, not a rational calculation of intrinsic worth. Compounding this is the sunk cost fallacy. This is our irrational tendency to continue with a course of action, because we have already invested significant time, money, or effort into it, even if new information suggests it's a losing proposition. Imagine a company that initiates a $5 billion buyback program when its stock is at $50 a share, a price they deem to be below intrinsic value. The program begins, and they spend $2 billion, but then good news hits, and the stock soars to $100 a share, a price now clearly above intrinsic value. The rational move would be to immediately halt the buyback program. The conditions that made it a smart decision have vanished. But the sunk cost fallacy kicks in. The CEO and the board think, "We've already committed to a $5 billion program. We've announced it to Wall Street. We have $3 billion left to spend. We can't just stop now." They feel compelled to follow through on their original plan, to finish the job, even though the job is now a value-destroying one. They are throwing good money after bad, driven by the psychological weight of their past commitment, rather than a clear-eyed analysis of the present reality. An intelligent investor learns to recognize the signs of this kind of thinking. When a company continues a massive buyback program, as its stock hits new all-time highs and its valuation metrics stretch to their limits, it's a red flag. It suggests that the decision-making process may be clouded by psychological biases rather than grounded in the disciplined, price-sensitive logic of true value investing. The best managers, the ones who create lasting wealth, have the intellectual honesty to overcome these biases. They are able to look at their own company's stock as dispassionately as any other investment, and they have the courage to stop a program, even one they championed, the moment the price no longer makes sense. So how can you, in your personal quest for financial freedom, systematically avoid being the victim of these value-destroying buybacks and instead align yourself with the value-creating ones? You need an applied mental model, a practical filter to run every company's buyback program through. We'll call this the margin of safety buyback filter. It's a simple but rigorous checklist. Step 1. Establish an independent and conservative estimate of intrinsic value. This is the most crucial step. You cannot rely on the CEO's opinion or the market's sentiment. You must do your own work. There are several methods for this, and using a combination is often best. You could use a discounted cash flow (DCF) analysis to project the company's future cash flows and discount them back to the present. You could look at relative valuation metrics like the price-to-earnings ratio, price-to-book, or EV to EBITDA, and compare them to the company's own historical averages and to its closest competitors. You could calculate the owner earnings, a Buffett-style metric. The specific method is less important than the mindset. The goal is to arrive at a conservative, defensible range of what the entire business would be worth to a private owner. Let's say you analyze a company and determine its intrinsic value is somewhere between $100 and $120 per share. That is your anchor. Step 2. Compare your value estimate to the current market price and demand a discount. This is the margin of safety, a concept Benjamin Graham, Buffett's mentor, called the 3 most important words in investing. If the stock is trading at $110, within your value range, a buyback is acceptable but not great. If it's trading at $150, well above your estimate, a buyback is an act of value destruction, and you should view it with extreme skepticism. But if the stock is trading at $70, you have a significant margin of safety. A buyback at this price is not just a good use of capital, it is a spectacular one. As an investor, you should actively seek out companies that are buying back stock under these conditions. Step 3. Scrutinize management's commentary. This is a qualitative check that complements the quantitative analysis. Read the CEO's letter to shareholders in the annual report. Listen to the quarterly conference calls. Are they talking about the buyback in the right way? A management team that is truly aligned with shareholders will say things like, "We will be aggressive with our share repurchases when we believe our stock is trading at a significant discount to its intrinsic value." Or, "We view our stock as just one of many potential investments for our capital, and we will only buy it when it offers a superior return to other available opportunities." This language shows they understand the principle of price versus value. Be wary of managers who use vague justifications like, "We are buying back stock to return capital to shareholders and offset dilution." This is generic corporate speak. It lacks the intellectual rigor of a price-sensitive capital allocator. By combining these 3 steps, your own valuation work, a strict demand for a margin of safety, and a qualitative analysis of management's thinking, you create a robust filter. This blueprint elevates your stock analysis from simply observing corporate actions to deeply understanding the intelligence and discipline behind them, putting you in a position to identify the truly exceptional asset management teams. The antithesis of the intelligent, price-sensitive buyback is a far more common and insidious maneuver, the propping up the stock buyback. This is when a company repurchases its shares not because they are undervalued, but for cosmetic reasons, primarily to artificially inflate earnings per share and hit quarterly financial targets. This practice is particularly prevalent in companies whose executive compensation is heavily tied to short-term stock performance, or EPS growth. Here's how the game is played. A company is nearing the end of a quarter and realizes it's going to miss the Wall Street consensus EPS estimate by a few pennies. Missing this estimate, even by a small amount, can cause the stock to drop significantly. The management team panics. They have a choice. They can report the reality of their business performance, or they can engage in some short-term financial engineering. So they instruct the corporate treasury to go into the market and buy back a large block of shares, often using borrowed money or debt. By reducing the number of shares outstanding just before the reporting period ends, they can magically boost the EPS number right over the finish line. The denominator in the earnings per share equation gets smaller, so the result gets bigger. Wall Street is pleased, the stock price holds steady or even rises, and the executives collect their performance bonuses. But what has actually happened? The company has likely overpaid for its own stock, buying it at or near an all-time high. It has taken on debt, increasing the financial risk of the enterprise. And it has used precious capital that could have been reinvested into the business for long-term growth or saved for a future opportunity. It's a sugar high. It creates the illusion of performance in the short term, but it mortgages the company's future and destroys value for the long-term owner. This is a cynical game that prioritizes the quarterly stock price over the decade-long growth of intrinsic business value. It's a hallmark of a management team that thinks like a stock promoter, not a business owner. Investors who fall for this trick are focusing on the wrong thing. They are watching the EPS number and the stock price, which can be easily manipulated, instead of the underlying health and value of the business. The intelligent investor understands that real value is created by improving the operations of the business, and by being a shrewd capital allocator. They know that a company that has to resort to these kinds of last-minute games to make its numbers is likely a company with deeper problems, a company whose stock is best avoided, regardless of how smooth its reported EPS growth may appear. The propping up the stock maneuver is a siren song that leads directly to the rocks of poor long-term returns. Let's put concrete numbers to this distinction to see the dramatic financial consequences. We will create a tale of two companies, both starting from the same place but ending in vastly different financial universes due to their buyback philosophy. Let's call them Value Creators Inc. and Ego Boosters LLC. Both companies have a stable intrinsic value of $1 billion and start with 100 million shares outstanding for an intrinsic value of $10 per share. Both generate $50 million in free cash flow each year to be used for buybacks. Over the next 2 years, the market goes on a roller coaster. In year 1, a market panic sends both stocks down to $5 per share, a 50% discount. In year 2, a speculative frenzy sends both stocks soaring to $20 per share, a 100% premium to their intrinsic value. Ego Boosters LLC has a rigid, price-insensitive buyback plan. They have announced they will spend $50 million a year to return capital to shareholders. In year 1, when their stock is at $5, they spend their $50 million and repurchase 10 million shares. Their share count falls to 90 million. This is a value-creating action. But in year 2, when the stock is at $20, they stick to their plan. They spend their $50 million and repurchase only 2.5 million shares. They have now spent $100 million and reduced their share count from 100 million to 87.5 million. But in that second year, they spent $50 million to buy shares worth only half that in intrinsic value, effectively lighting $25 million of shareholder money on fire. Now let's look at Value Creators Inc. They are intelligent, price-sensitive allocators. In year 1, when their stock is at $5, they see a golden opportunity. They not only spend their $50 million in cash flow, but they also decide to borrow an additional $50 million, recognizing this is the best investment they can possibly make. They spend $100 million and repurchase a whopping 20 million shares. Their share count plummets to 80 million. In year 2, when their stock soars to $20, far above their estimate of intrinsic value, they do the opposite. They halt their buyback program completely. They see no sense in paying $2 for $1 of value. They simply hold their $50 million in cash, waiting for a better opportunity. After 2 years, what is the result? Ego Boosters LLC has 87.5 million shares outstanding. Their intrinsic value is the original $1 billion, minus the $100 million they spent, so $900 million. Their intrinsic value per share is $10.28, a pathetic return for all that activity. Value Creators Inc. has 80 million shares outstanding. Their intrinsic value is the original $1 billion minus the $100 million they spent, plus the $50 million in cash they retained in year 2, and minus the $50 million in debt they took on. Their intrinsic value is $900 million, but that $900 million is divided by only 80 million shares. Their intrinsic value per share is $11.25. By being smart, flexible, and price-sensitive, Value Creators Inc. generated nearly a full dollar more in intrinsic value per share for their owners. They created significantly more wealth by being inactive in the second year than Ego Boosters did by blindly following their plan. This direct financial comparison makes the point undeniable. The intelligence of a buyback is not in the action itself, but in the price-conscious judgment behind the action. It's a lesson in corporate finance that, once learned, will forever change how you analyze a company's capital allocation strategy. To truly master the Warren Buffett strategy, we must place intelligent share buybacks within the broader context of capital allocation. A company with excess cash has, broadly speaking, 3 choices. reinvest it in the business, acquire another business, or return it to shareholders. If a company can return it to shareholders, it has two primary methods: paying a cash dividend or repurchasing its own shares. Understanding why a buyback is often superior to these other alternatives, particularly dividends, is a cornerstone of advanced financial education. A powerful anecdote that illuminates this choice comes from another chapter in the Buffett saga, his investment in American Express during the infamous salad oil scandal of 1963. American Express, then primarily a traveler's check and credit card company, had a warehousing division. A client, the Allied Crude Vegetable Oil Company, secured huge loans using receipts for tanks of salad oil as collateral, which were guaranteed by American Express. The problem was, the tanks were mostly filled with seawater, with only a thin layer of oil on top. When the fraud was discovered, Allied went bankrupt, and American Express was on the hook for massive losses, potentially exceeding its entire net worth. Wall Street panicked. Investors dumped the stock, fearing the company would be wiped out. The price plummeted by over 50%. Buffett, ever the contrarian, conducted his own investigation. He went to restaurants and banks, observing that customers and merchants were still using American Express cards and travelers' checks. The core business, the powerful brand, was unaffected by the scandal in the warehousing division. He concluded the company would survive and was now trading at a massive discount to its long-term earning power. He invested 40% of his partnership's capital, a huge bet, and bought a 5% stake in the company. The bet paid off handsomely as the company weathered the storm. But the relevant lesson for our discussion comes in the years that followed. American Express recovered and became a cash-generating powerhouse. With its stock still trading at a very reasonable valuation, the management began a significant share buyback program. Every dollar spent on repurchasing its cheap stock magnified the returns for the remaining shareholders, including Buffett. Now consider the alternative. What if, instead of buying back its undervalued stock, American Express had chosen to pay out all its excess cash as dividends? Buffett would have received his check, which would have been immediately taxed as ordinary income, at a high rate. To get the same compounding effect, he would have had to take his after-tax dividend money and buy more shares of American Express on the open market himself. The buyback accomplished the same goal, increasing his ownership stake, but it did so in a far more efficient manner. There was no immediate tax event. The company used its pre-tax corporate cash to increase his ownership for him. It was a silent, automatic, and tax-deferred compounding of his investment. This story highlights a key advantage: tax efficiency. A buyback allows shareholders to decide for themselves when they want to realize a capital gain and pay the corresponding tax, which is often at a lower rate than the tax on dividends. A dividend forces a taxable event on every single shareholder, whether they need the cash or not. When a company's stock is cheap, a buyback is a way of forcibly reinvesting the company's capital at a very high rate of return on behalf of the shareholders, a service that is often far more valuable than simply handing them the cash. The superiority of buybacks over dividends is not just about taxes, it's rooted in a deep psychological principle: loss aversion. Decades of research by behavioral economists like Daniel Kahneman and Amos Tversky have shown that humans feel the pain of a loss about twice as strongly as they feel the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This is a powerful, irrational force that shapes our financial decisions. How does this relate to capital allocation? A dividend is a certain event that, for a taxable investor, is always accompanied by a certain loss, the payment of taxes. The day the dividend hits your account, you see the gross amount, and you know that a portion of it, 15, 20, 30% or more, is not truly yours. It belongs to the government. This is a tangible, immediate, and psychologically painful loss. You are poorer by the amount of the tax, and there is nothing you can do about it. A share buyback, on the other hand, operates in the realm of gains. When a company buys back its stock, the value of your shares increases. This is a gain. It is unrealized, meaning you haven't sold the shares yet, so you haven't paid any tax. The tax event is deferred to a future date of your choosing. The entire process feels positive. Your ownership stake grows, the intrinsic value per share increases, and there is no immediate, painful loss to the tax authorities. This psychological framing makes a huge difference. Investors and even corporate managers are naturally drawn to avoid the certain, immediate pain of the dividend tax. The buyback provides a path to shareholder returns that is not only often more mathematically efficient, but also psychologically more palatable. Furthermore, the decision of what to do with capital is a signal. A company that pays a large and growing dividend is often signaling that it is a mature business with limited high-return investment opportunities. A company that is aggressively buying back its own stock, especially when it is undervalued, is sending a much more powerful signal. It is telling the world that it believes the single best investment on the planet is itself. This is an enormous vote of confidence from the people who know the business best, its own management. It creates a feedback loop of optimism and reinforces the value proposition for the long-term investor. The intelligent investor understands this signaling and the underlying psychology. They recognize that a tax-efficient, deferred gain from a buyback is often far preferable to a tax-inefficient, immediate gain from a dividend, especially when the goal is long-term portfolio growth and wealth compounding. To make this practical, an investor needs a structured way of thinking about these choices. The capital allocation decision tree is a mental model that allows you to step into the shoes of a CEO and evaluate their decisions with clarity and logic. It's a flowchart for corporate finance. The tree begins with a single question: does the company have excess cash after funding all its necessary operational expenses? If the answer is no, the tree ends. If the answer is yes, you move to the first branch. Branch 1. Are there high-return organic reinvestment opportunities within the existing business? This is almost always the best use of capital. Can the company build a new factory that will generate a 25% return on investment? Can it spend on research and development to create a new blockbuster product? Can it expand its sales force to enter a new market? If such opportunities exist, a smart CEO should fund them to the hilt. This grows the intrinsic value of the entire enterprise. As an investor, your job is to assess if management's projects are genuinely high return or just wishful thinking. If the answer at this branch is yes, the cash should be reinvested. If the answer is no, the company is a mature business and has run out of high-return internal projects, you move down the tree. Branch 2. Is the company's stock currently trading at a significant discount to a conservative estimate of its intrinsic value? This requires the margin of safety filter we discussed earlier. If the answer is a clear yes, then the choice is simple. An aggressive share buyback is likely the most logical and value-creating use of capital. It offers a high, low-risk return by investing in a business they know intimately. If the answer is no, the stock is fairly valued or overvalued, then a buyback would be foolish. You then proceed to the next branch. Branch 3. Are there opportunities to acquire other businesses at prices that offer a return superior to what a share buyback would have offered? This is the acquisition question. It's a high bar to clear. The acquiring company must not only buy the target at a reasonable price, but also successfully integrate it and realize the promised synergies. This is notoriously difficult. If a truly compelling bolt-on acquisition target exists at a bargain price, it can be considered. But this is the exception, not the rule. If no such opportunity exists, you move to the final branch. Branch 4. If there are no high-return internal projects, the stock is not cheap, and there are no attractive acquisition candidates, what is the final option? Return the cash to the shareholders in the form of a dividend. A dividend, in this framework, is the default option, the action taken when all other, more value-accretive options have been exhausted. It is an admission by management that the shareholders can likely find a better use for the capital than the company can. By using this decision tree, you can systematically analyze and grade the capital allocation skills of any management team. You are no longer just a passenger. You are a co-pilot, thinking through the strategic options and judging whether the people in charge are making rational, value-maximizing choices on your behalf. The road of corporate finance is littered with the wreckage of companies that failed to navigate this decision tree correctly. The most common and destructive error is what Peter Lynch famously termed diversification. This is the antithesis of intelligent capital allocation. It occurs when a company, having matured in its core business and run out of high-return reinvestment opportunities, decides to enter a completely new and unrelated field through an expensive acquisition, rather than simply returning the cash to shareholders. The logic is often flimsy, based on vague notions of diversification or chasing the latest hot trend. A classic example from business history is the Mobil Oil Corporation's decision in the 1970s to buy the department store chain Montgomery Ward. What did an oil company know about retail? Absolutely nothing. The management at Mobil had an enormous amount of cash from the high oil prices of the era, and instead of giving it back to their owners via dividends or buybacks, they felt an institutional pressure to do something with it. They bought a struggling, second-rate retailer in a fiercely competitive industry they did not understand. The result was a predictable disaster. Mobil poured billions of dollars into Montgomery Ward over the years, trying to turn it around, but the investment was a constant drag on the oil company's profits and a massive destroyer of shareholder value. The capital could have been used to buy back Mobil's own undervalued stock, which would have created immense wealth. Instead, it was incinerated in the furnace of a terrible acquisition. This is the diversification trap. It stems from a combination of managerial arrogance, the belief that their skills are transferable to any industry, and the action bias we discussed earlier. It is far more exciting for a CEO to announce a bold move into a new industry than to announce a plan to return cash to the people who actually own the company. Shareholders in such a company should be terrified. When you see a company you own, say a successful software company, suddenly announce it is buying a chain of restaurants, your alarm bells should be screaming. It is a giant red flag that management has run out of good ideas in their own circle of competence and is about to embark on a value-destroying adventure with your money. The intelligent investor prizes focus. They prefer a company that sticks to what it knows, and when it can no longer reinvest capital at high rates within that area of expertise, has the discipline and humility to give the money back. The diversification trap is the path of the 99%. The path of disciplined capital return is the path to true, long-term portfolio growth. Let's make this tangible with a direct financial comparison. Imagine you are a shareholder in a company that has $1 billion in excess cash it intends to return to you. Let's examine the financial consequences of the two primary methods: a special dividend versus a share buyback executed when the stock is undervalued. Let's assume the company has a market capitalization of $10 billion, and you own 1% of the company, a stake worth $100 million. Option A, the company pays a $1 billion special dividend. As a 1% owner, you receive a check for $10 million. However, this dividend is taxable. Assuming a qualified dividend tax rate of 20%, for simplicity, it could be higher, you immediately owe $2 million in taxes. Your net cash received is $8 million. Your remaining stake in the company is now worth $90 million. 1% of the new $9 billion company as $10 billion minus the $1 billion cash paid out. Your total net worth is $98 million, $90 million in stock and $8 million in cash. You are $2 million poorer because of the immediate tax liability. Option B. The company's stock is trading at a 20% discount to its intrinsic value. Instead of paying a dividend, the management uses the $1 billion to repurchase its own shares. Because the stock is cheap, they are able to buy back more than 10% of the company. Let's say they repurchase 12% of the shares outstanding. The number of shares is permanently reduced. Your 1% ownership stake has now automatically increased to approximately 1.14% of the company. 1 to 0.12. The company is now worth $9 billion, but you own a larger piece of it. The value of your holding is now 1.14% of $9 billion, which is approximately $102.6 million. You have received no cash, so there is no immediate tax event. your net worth has increased from $100 million to $102.6 million. Compare the two outcomes. The dividend resulted in a net worth of $98 million. The intelligent share buyback resulted in a net worth of $102.6 million. The buyback has created $4.6 million in additional value for you compared to the dividend. This is not magic. It is the direct financial result of two key factors. First, the tax efficiency of deferring the capital gain, and second, the value accretion of buying back shares at a discount. The company used your share of the $1 billion to buy out other shareholders for you at a bargain price. This numerical comparison is the definitive argument. It demonstrates in stark and unambiguous terms how an intelligent share buyback is not just an alternative to a dividend, but a demonstrably superior method of enhancing shareholder value when the conditions are right. This is the kind of sophisticated asset management that separates the world's greatest investors from the rest. The numbers and the logic are one thing, but a successful investment strategy often comes down to the people. It's about identifying management teams that don't just understand the math of capital allocation but live by its philosophy. You need to find leaders who genuinely think and act like owners. This is the core of the principal-agent problem, and finding its solution is a key to successful stock picking. A shining, though lesser-known example of a company built on a foundation of intelligent buybacks is NVR Inc., one of the largest home builders in the United States. Its story is a testament to the power of a relentless, decades-long focus on per-share value growth. NVR was founded by Ryan Schuchart, a leader with an almost fanatical devotion to rational capital allocation. From the company's early days, Schuchart established a corporate culture that was radically different from its competitors. While other home builders were engaged in a mad dash to acquire vast tracts of land, a risky, capital-intensive strategy, Schuchart implemented a land-light model. NVR doesn't buy large amounts of land. Instead, it secures options to buy lots from developers. This dramatically reduces the company's capital requirements and protects it from the brutal downturns of the housing cycle. This operational discipline meant that NVR consistently generated enormous amounts of free cash flow, and this is where Schuchart's genius truly shone. He recognized that the home building industry was cyclical and that the market would frequently misprice NVR's stock, particularly during periods of fear about the housing market. He decided that the primary method for returning this cash to shareholders would be through share repurchases, and he was not just a casual buyer, he was a voracious one. For decades, NVR has used virtually all of its excess cash to buy back its own stock, especially during industry downturns when the shares were cheapest. The company has almost never paid a dividend. The results have been nothing short of breathtaking. Since its IPO, NVR has repurchased over 75% of its original shares outstanding. Think about that. 3/4 of the ownership claims on the business have been extinguished. For the long-term shareholder who simply held on, their ownership stake in this highly profitable enterprise has quadrupled, without them investing another penny. The effect on the stock price has been astronomical. A small investment in NVR in the mid-1990s would be worth a fortune today, having created life-changing wealth for its patient owners. Ryan Schuchart and his successors at NVR represent the ideal. They are masters of the craft. They built a great business operationally, and then used the fruits of that business to relentlessly increase the ownership stake of their long-term partners. Finding a management team with this kind of discipline and owner-oriented mindset is the holy grail of value investing. The central challenge for any investor is that corporate managers, the agents, do not always act in the best interests of the company's owners, the shareholders, the principals. This is the classic principal-agent problem. Agents are human, and they are motivated by their own incentives: salary, bonus, stock options, prestige, and the size of the empire they command. These incentives are often not perfectly aligned with the long-term goal of maximizing per-share intrinsic value. For example, a CEO whose bonus is tied to revenue growth has a strong incentive to pursue large, revenue-boosting acquisitions, even if those acquisitions are done at a terrible price and destroy shareholder value. A CEO who wants the prestige of running a Fortune 100 company is incentivized to grow the company at all costs, rather than focusing on profitability and returns on capital. An intelligent share buyback program is one of the most powerful signals you can find that a company's management has successfully overcome the principal agent problem. Why? Because a buyback, especially when done at a discount to intrinsic value, is an act of profound alignment with the shareholders' interests. It does very little for the typical agent's incentives. It doesn't increase revenue. It doesn't increase the number of employees. It reduces the cash on the balance sheet and, in a way, shrinks the size of the company's assets. It is an act of pure capital discipline. It is an admission from management that they believe the owner's capital is best served by increasing their stake in the existing business, rather than expanding the managerial empire. When you find a CEO who talks passionately about buying back the company's stock when it's cheap, you are likely listening to someone who thinks like a principal, not an agent. They see themselves as a steward of the owner's capital, with a fiduciary duty to deploy it at the highest possible rate of return. They are not just managing a company, they are compounding their partners' wealth. This psychological alignment is incredibly rare and immensely valuable. It's the difference between hiring a caretaker to watch your house and having your dedicated brother manage your affairs. The caretaker will follow the rules, but your brother will act with your best interests at heart, even when it's not the easiest or most glorious path. The intelligent investor is constantly searching for signs of this ownership mindset, because they know that in the long run, betting on managers who are aligned with you is one of the most reliable ways to achieve superior portfolio growth. How do you find these rare, owner-oriented managers from the outside? You can't sit in on their board meetings, but you can read their mail. The shareholder letter analysis protocol is a mental model for dissecting a company's annual report, not for the numbers, but for the language, the philosophy, and the clues hidden in plain sight. This is a qualitative deep dive that separates the true capital allocators from the corporate jargon artists. Step 1. Obtain the last 5 to 10 years of the company's annual reports. Don't just read the most recent one. You are looking for consistency of message and philosophy over a full business cycle. The CEO's letter to shareholders is your primary document. Step 2. Create a good words versus bad words checklist. Your good words list should include phrases that signal an owner's mindset. Look for terms like intrinsic business value, per share value, margin of safety, rational capital allocation. We think like owners. We will only repurchase our shares when they trade at a discount to our conservative estimate of their value. The repeated use of this vocabulary is a very positive sign. Your bad words list should include vague, buzzword-heavy corporate speak. Be wary of phrases like leveraging synergies, strategic transformation, maximizing shareholder value used without specific metrics, growth-oriented acquisitions, and heavy reliance on adjusted, non-GAAP earnings figures. This is often the language of obfuscation, designed to sound good without saying anything meaningful. Step 3. Analyze how they discuss failure. Does the CEO openly and honestly discuss mistakes they've made, such as a bad acquisition or a failed product launch? A manager who takes personal responsibility for failures is demonstrating intellectual honesty and an owner's accountability. A manager who blames external factors or glosses over mistakes is more likely an agent protecting their own reputation. Buffett's letters are famous for this level of candor. Step 4. Evaluate their capital allocation discussion. This is the heart of the analysis. Do they lay out a clear, logical framework for how they will deploy excess cash, similar to the decision tree we discussed? Do they talk about share buybacks with a clear reference to price versus value? Or is their discussion of buybacks and acquisitions generic and boilerplate? The best letters will educate you on their business and their capital allocation philosophy. The worst will read like they were written by a committee of lawyers and public relations consultants. By applying this protocol, you move beyond being a passive recipient of information and become an active interpreter of corporate culture and managerial intent. You learn to read between the lines to distinguish the signal from the noise. This skill, which requires practice but no special financial degree, is an invaluable tool in your arsenal for stock analysis and is a core component of any serious financial education. The dark side of this principle, the antithesis of the owner-oriented manager, is the executive who uses buybacks not as a tool for value creation, but as a mechanism to manipulate their own compensation. This is the world of executive compensation games, and it's a trap that ensnares many investors who are not paying close attention. In many modern corporations, a large portion of a CEO's pay is tied to performance metrics. One of the most common metrics is earnings per share, EPS growth. If the CEO can increase EPS by a certain percentage, they receive a large bonus, often in the millions of dollars. This creates a powerful and potentially perverse incentive. As we've established, one of the easiest ways to increase EPS is to reduce the number of shares outstanding through a buyback. A CEO who is focused on hitting their quarterly or annual EPS target to trigger a bonus has a very strong personal incentive to authorize buybacks, regardless of whether the stock is undervalued or not. Let's say a company needs to hit an EPS of $5 to unlock a $10 million bonus for the executive team. At the end of the year, the earnings are coming in a little short, and the EPS is projected to be only $4.80. The CEO can either accept the lower bonus, or they can use the company's cash, or even take on new debt, to launch a massive, last-minute share buyback. By aggressively reducing the share count, they can push the EPS number over the $5 threshold. They get their bonus, but the company is now weaker. It has less cash, more debt, and has likely overpaid for its own stock. Shareholder value has been destroyed, but the executive's personal wealth has been enhanced. This is the principal agent problem at its most toxic. The agent is enriching themselves at the direct expense of the principal. An investor must be a detective, looking for clues of this behavior. One of the best places to look is the company's proxy statement, where the details of executive compensation plans are disclosed. If you see that a CEO's bonus is heavily tied to short-term EPS targets, and you also see that the company is buying back its stock at historically high valuations, you have found a giant red flag. You are likely looking at a management team that is playing games with your money. The truly great companies, by contrast, tend to have compensation plans that are aligned with long-term value creation. They might tie bonuses to return on invested capital, or the growth of intrinsic value over a multi-year period, metrics that are much harder to manipulate with short-term financial engineering. Understanding these games is a critical part of a sophisticated approach to asset management. It allows you to avoid companies run by agents and instead invest alongside true principles. The financial chasm between a company run by an owner-oriented capital allocator and one run by a professional manager playing compensation games becomes starkly evident over the long term. Let's chart the hypothetical 10-year journey of two investors, each putting $100,000 into two different companies. Investor A buys shares in long-term compounding company. This company is run by a CEO who thinks like a founder. The CEO's letters clearly state that they will only buy back stock when it's trading at a significant discount. Over the next decade, the market experiences two major downturns. During these periods of peak fear, the CEO of long-term compounding company becomes a voracious buyer of their own stock, using all of the company's excess cash flow and even some prudently borrowed debt to repurchase shares at bargain prices. During the bull market years when the stock is expensive, they halt the buyback program entirely and build up cash or pay a small dividend. Investor B buys shares in Steady Eddy Inc. This company is run by a CEO whose bonus is tied to achieving smooth, predictable 5% annual EPS growth. To achieve this, The company has a consistent buyback program, spending a set amount of money each and every quarter to repurchase shares regardless of the stock's valuation. They buy at the peaks, they buy at the troughs. Their EPS growth looks beautiful and smooth on a chart. After 10 years, what are the results? The total earnings of both businesses have grown by the exact same amount. But the outcomes for the shareholders are wildly different. At Steady Eddy Inc., the constant buybacks at both high and low prices have had a muted effect. The share count has decreased, but a significant portion of the capital was deployed at unattractive prices, destroying some value. Investor B's $100,000 investment might have grown to $250,000, a decent but not spectacular return. At long-term compounding company, the results are explosive. The opportunistic buybacks during the downturns dramatically reduced the share count at the most advantageous moments. The capital was deployed with precision, generating extremely high rates of return. The same amount of total cash spent on buybacks had a vastly magnified impact on the per-share value. Investor A's $100,000 investment has ballooned to $500,000 or more. The difference in total shareholder return is enormous. It is the direct financial consequence of the intelligence behind the capital allocation. This is the ultimate connection. The philosophy of a management team, as esoteric as it may sound, translates directly and powerfully into the dollars and cents in your investment account over the long run. The greatest wealth management tool is not a complex derivative or a hot stock tip. It is the simple act of finding and partnering with managers who understand and flawlessly execute this principle. The true magic of an intelligent share buyback program reveals itself over long stretches of time. It's not about a one-time pop in the stock price. It's about creating a relentless, silent compounding machine that fuels the creation of generational wealth. A short-term trader will never experience this power. It is a reward reserved exclusively for the patient, long-term business owner. The most potent, modern example of this principle in action is, without a doubt, Berkshire Hathaway's investment in Apple. Warren Buffett began accumulating a massive position in the iPhone maker in 2016. He was attracted by the company's incredible brand loyalty, its ecosystem of products, and its phenomenal profitability. But a crucial and often overlooked part of the investment thesis was Apple's gargantuan capital return program. At the time Buffett was buying, Apple was generating more cash than it could sanely reinvest in its own business. Under the leadership of Tim Cook, the company had committed to returning this enormous trove of cash to shareholders, primarily through aggressive share repurchases. Buffett saw this not as a gimmick but as a core feature of the investment. He calculated that Apple's stock, while not dirt cheap, was trading at a reasonable price relative to its long-term earning power. Therefore, every $1 billion that Apple spent on buybacks was a rational and value-accretive use of capital. What has happened since is a masterclass in ownership compounding. Berkshire Hathaway built up its stake to own roughly 1 billion shares of Apple, which represented about 5.2% of the company. In the years since, Buffett has actually been a small net seller of Apple stock, trimming the position for portfolio management reasons. Yet paradoxically, Berkshire's ownership percentage times of Apple has actually gone times. Today, Berkshire owns well over 6% of Apple's business. How is this possible? It's the magic of the buyback. While Buffett was a small seller, Apple itself was an enormous buyer of its own stock. The company has spent hundreds of billions of dollars repurchasing and retiring its own shares. The total number of Apple shares outstanding has shrunk dramatically. So while Buffett's share count went down slightly, the total number of slices in the pie shrunk so much faster that his slice actually became a bigger piece of the overall pie. Think about the implications of this. Berkshire Hathaway's claim on Apple's future earnings is growing every single day, without them having to lift a finger or invest another dollar. Apple's management is, in effect, working to make their largest shareholder richer by continuously buying out other, less permanent shareholders. This is the compounding machine in its most powerful form. It's an almost invisible tailwind that boosts long-term returns in a way that few market participants truly appreciate. It's not about the daily fluctuations of the stock price. It's about the steady, inexorable increase in your ownership of a great business, funded by the business itself. This is the ultimate promise of intelligent share buybacks, a perpetual motion machine for growing your wealth. The reason so few people grasp the immense power of this long-term effect is because the human brain is notoriously bad at understanding exponential growth. We are linear thinkers living in an exponential world. This is what gives rise to the get-rich-quick illusion versus the slow, almost boring reality of true wealth compounding. This cognitive blind spot is perfectly illustrated by the ancient parable of the inventor of chess. The story goes that the emperor was so pleased with the new game that he offered the inventor any reward he desired. The inventor made a humble request: place 1 grain of rice on the first square of the chessboard, 2 on the second, 4 on the third, 8 on the fourth, and so on, doubling the amount for each of the 64 squares. The emperor, thinking this a trivial price, immediately agreed. The first few squares are unremarkable: 1, 2, 4, 8, 16 grains. Even halfway through the board, the amounts are manageable, but as the doubling continues on the second half of the board, the numbers become astronomical. The final square alone would require a pile of rice larger than Mount Everest. The emperor was bankrupt. This is the nature of exponential growth. It starts slowly and then explodes. Intelligent share buybacks are a form of financial exponential growth. In the first year, a 2% reduction in share count is barely noticeable. After 5 years, it starts to add up. But after 20 or 30 years of a company consistently repurchasing 5% of its shares annually at reasonable prices, the effect is like the second half of the chessboard. The original shareholder's stake in the business has grown to a massive degree, and the value of their initial investment has compounded to an almost unbelievable figure. Most investors don't have the patience for this. They are drawn to the lottery ticket, the biotech stock that might triple overnight, or the splashy merger that promises instant transformation. They are playing for the first few squares of the chessboard. The slow, methodical increase in ownership from a multi-decade buyback program doesn't provide the same dopamine hit. It feels like watching paint dry. But for those who understand the math, for those who can overcome their innate psychological desire for fast, linear gains, this is where the real, durable wealth is built. The intelligent investor is not looking for a quick win. They are looking to place their capital on a square that will double for the next 30 years. To truly internalize this, let's create a final, applied mental model, the ownership compounding calculator. This is a simple exercise you can do on a piece of paper or a spreadsheet that will forever change how you view a long-term investment in a company with a strong buyback program. Let's set up the scenario. You purchase 100 shares of a company, Compounding Champions Inc. The company currently has 10,000 shares outstanding in total. Your 100 shares represent exactly 1% ownership of the entire business. Let's assume the total intrinsic value of the business today is $1 million, making your stake worth $10,000. Now let's assume the management of Compounding Champions is brilliant. The business grows its intrinsic value by a steady 7% per year. In addition, the company generates enough excess cash to repurchase 3% of its outstanding shares each year, and it's able to do so at prices at or below intrinsic value. Let's run the numbers for 20 years. In year 1, you own 1% of a $1 million business. In year 2, the business value grows by 7% to $1.07 million. The company repurchases 3% of its shares. The new share count is 9,700. Your 100 shares now represent 1.03% of the business. Your stake is now worth 1.03% of $1.07 million. Which is approximately $11,021. A nice gain. But let's not calculate every year. Let's jump to the end of year 20. After 20 years of growing at 7%, the total intrinsic value of the business will be approximately $3.87 million. After 20 years of reducing the share count by 3% annually, the number of shares outstanding will have fallen from 10,000 to just over 5,400. Your original 100 shares now represent not 1%, but approximately 1.85% of the business. Your ownership stake has nearly doubled, without any further action on your part. So what is your investment now worth? It's 1.85% of a $3.87 million business. Your initial $10,000 investment is now worth over $71,000. Now compare this to a similar company that also grew its value by 7% a year but did not buy back any stock. Your 1% stake would only be worth $38,700. The intelligent buyback program has nearly doubled your total return. This simple calculation demonstrates the dual engines of long-term value creation, the growth of the business itself, and the growth of your ownership stake in that business. When you find a company that has both engines running at full throttle, you have found a potential multi-bagger, a true compounding machine for your portfolio. The greatest enemy of this powerful wealth-creating engine is not a bad economy or a market crash. It is the investor's own behavior. The trader's mindset is the antithesis of everything we have discussed. The trader is obsessed with the short term. They watch the stock price ticker all day, hanging on every news headline and every analyst upgrade or downgrade. They buy a stock hoping to sell it a few weeks or months later for a quick profit. The trader sees the stock price, but they are completely blind to the slow, steady accumulation of per-share intrinsic value happening underneath the surface. Let's revisit our compounding champions example. A trader might buy the stock at the beginning of the year, see it go up 15%, and sell to lock in their gain. They feel smart. They've made a quick profit. But what have they given up? They have given up their seat on the compounding train. They have sold their small but growing piece of a wonderful business that was actively working to make them richer over the long term. They captured a single linear gain, but they sacrificed the potential for a massive exponential one. The long-term owner, by contrast, largely ignores the short-term stock price fluctuations. They understand that the price is just the temporary opinion of a manic-depressive market. Their focus is on the fundamental reality of the business and the intelligence of its management. They see a market downturn not as a reason to panic and sell, but as an opportunity for the company they own to accelerate its buyback program and repurchase shares even more cheaply, thereby enhancing their own long-term returns. This requires a profound psychological shift, a move from viewing stocks as flashing symbols on a screen to viewing them as ownership stakes in real businesses. It is the difference between being a renter and an owner. The renter worries about the daily news. The owner focuses on the long-term value of the property. To benefit from the incredible power of ownership compounding through intelligent share buybacks, you must have the temperament and the fortitude to be an owner, to sit still and let the machine do its work for you over the course of years and decades. The trader will always be on the outside looking in, forever chasing the next hot trend, while the owner quietly and patiently becomes rich. Let's conclude by tying this all together with a final, direct financial connection, modeling the long-term performance of two distinct wealth management strategies. We will construct two portfolios, each starting with $100,000 and held for 25 years. Portfolio A is the dividend harvester. This portfolio invests exclusively in high-quality, stable companies that pay a generous and growing dividend. Let's assume these companies provide a solid 4% dividend yield and their underlying businesses grow at a modest 4% per year, for a total pre-tax return of 8%. Each year, the dividends are received, a 20% tax is paid on them, and the remaining after-tax proceeds are reinvested. Portfolio B is the ownership compounder. This portfolio invests in an equally high-quality group of companies that pay no dividend. Instead, they use all their excess cash for intelligent share buybacks. Let's assume these companies also grow their underlying business value by 4% per year. And their buybacks, executed at reasonable prices, effectively provide an additional 4% buyback yield for the same pre-tax total return of 8%. The key difference is that this return is not taxed annually. The gains are all deferred. We run the simulation for 25 years. In the early years, the two portfolios track fairly closely, but over time, a massive gap begins to open up. The dividend harvester portfolio is constantly being eroded by the quote tax drag. Every year, 20% of the dividend income is siphoned off to the government, reducing the amount of capital available for reinvestment and hamstringing the power of compounding. The ownership compounder portfolio, by contrast, is able to let its capital compound untaxed year after year. The full 8% return is working for the investor every single year. After 25 years, the results are staggering. The dividend harvester portfolio, after being steadily eroded by taxes, might have grown to around $430,000, a respectable result. But the ownership compounder portfolio, having benefited from 2.5 decades of uninterrupted, tax-deferred compounding, would have grown to over $680,000. That is over $250,000 in additional wealth, generated not by taking more risk or by picking better stocks, but simply by choosing a more intelligent and tax-efficient structure for capital return. This is the ultimate financial advantage. It is the mathematical proof that understanding the deep mechanics of corporate finance, specifically the power of the intelligent share buyback, is not just an academic exercise. It is a direct, quantifiable, and life-changing tool for building real, long-term wealth. You have now journeyed through the intricate machinery of true value creation. You possess a lens that few investors ever develop. You no longer just see a stock price fluctuating on a screen. You see the hidden engine of ownership compounding working silently beneath the surface. You can now distinguish with clarity the profound difference between mere corporate action and genuine corporate intelligence, a foundational principle in the world of sophisticated asset management. You understand that when a great business you own uses its own cash to buy out your partners at a discount, it is performing one of the most shareholder-friendly acts imaginable. But this mastery of capital allocation, this deep understanding of how a company intelligently returns its profits to you, is just one of the crucial pillars in the grand architecture of the intelligent investor. Knowing what a company does with its profits is immensely powerful, but it begs a more fundamental question. How do you first identify a truly great business? A business with a durable competitive advantage that will be gushing those profits for decades to come. That is the other side of the coin, the indispensable partner to the principle you have just mastered. The principles of intelligent stock buybacks are a powerful engine, but that engine must be installed in a world-class vehicle. The video that is about to appear on your screen is the next part of that essential blueprint. It is the guide to identifying the vehicle itself. It bridges the critical gap between capital allocation and business quality, linking the how you have just learned with the what you must now learn to find. Most people will stop here, satisfied with this single, powerful piece of the puzzle. But you are clearly on a different path. You are not just collecting tips. You are building a complete, interlocking mental framework for achieving financial freedom. The choice to click is not merely about watching another video. It is a declaration. It is a statement that you are committed to completing the map, to assembling the entire mental arsenal of the world's greatest investors. It is the next step in your ascent. Continue the journey.